Another day, another story. Navigating cash flow versus interest rates for mortgage refinancing and investment properties. Welcome to Financia, your go-to channel for all things personal finance in Canada. Let's talk about cash flow versus interest rates. If you invest in property or otherwise and leverage through financing, at some point, you will need to make this decision. So, understanding the nuances of cash flow and interest rates can make a significant difference in your financial health and decision-making. In this realm, few things are as impactful as the decisions surrounding mortgages. Whether you are a first-time home buyer, a seasoned investor, or someone considering refinancing your property, the choices you make can have lasting effects on your financial future. Understanding key concepts. Cash flow, the lifeblood of personal finance. If cash is king, then cash flow is either right in line or a very close second. Cash flow, in its simplest form, is the movement of money into and out of your wallet. It's a measure of financial health and the heartbeat of your personal economy. Positive cash flow occurs when your income exceeds your expenses, leaving you with surplus funds. Negative cash flow, on the other hand, happens when your expenses outweigh your income, a situation to avoid for long-term financial stability. In personal finance, managing cash flow is crucial. It determines your ability to pay bills, save for the future, and maintain a comfortable lifestyle. Cash flow management becomes even more critical when considering investments like property, where consistent cash flow can mean the difference between a successful investment and a financial strain. After-tax dollars are a vital component of this equation. Your income after taxes is what you have available to spend or save. Understanding how taxes impact your take-home pay helps in creating a realistic budget and, by extension, a robust cash flow management plan. In the context of mortgages and property investments, considering your cash flow in after-tax terms is essential to gauge the true affordability and profitability of your investments. Interest rates, the cost of borrowing. Interest rates are the cost you pay for borrowing money, expressed as a percentage of the principal amount. In mortgage terms, the interest rate is what the lender charges you for the loan to buy a property. A lower interest rate means lower monthly payments and less money paid over the life of the loan, making it an attractive option. Conversely, a higher interest rate results in higher monthly payments and a more significant amount of money paid in interest over time. The long-term impact of interest rates cannot be overstated. High rates can significantly increase the cost of a mortgage, affecting your cash flow and overall financial strategy. Lower rates, while reducing monthly payments, can also lead to more significant interest savings. So, in a perfect world, a lower rate should mean lower payment and therefore better cash flow. But we all know that it is not a perfect world. And sometimes you may have to give up that sexy rate in favor of cash flow. Opportunity cost is a fundamental concept in economics and finance that refers to the potential benefits an individual, investor, or business misses out on when choosing one alternative over another. In the context of choosing between a lower mortgage rate with a shorter amortization period and a higher mortgage rate with a longer amortization period, opportunity cost plays a crucial role in your decision-making process. The choice depends on a careful evaluation of your financial situation, goals, and the trade-offs you're willing to make. It's not just a mathematical decision. It also involves personal preferences and risk tolerance. Comparing cash flow versus lower interest rates. Scenario analysis. Real-world examples. To understand the trade-offs between better cash flow and lower interest rates, let's consider two common scenarios faced by Canadian homeowners and investors. Scenario 1. Opting for better cash flow. Example: John and Sarah have a mortgage with a slightly higher interest rate but lower monthly payments. This choice leaves them with more money each month for other expenses and investments. Impact: their higher interest rate means they'll pay more over the life of the mortgage, but the improved monthly cash flow allows them to invest in other areas, such as retirement funds or a child's education. Scenario 2. Choosing lower interest rates. Example: Mark and Priya refinanced their mortgage to secure a lower interest rate. Their monthly payments are higher, but they'll pay less in total interest over the life of the loan. Impact: While their monthly budget is tighter due to higher payments, the long-term savings and interest can be substantial, potentially freeing up funds in the future for other long-term financial goals. Pros and cons. Weighing the options. Better cash flow, lower payments, higher rates. Pros. Improved monthly budget flexibility. More immediate funds available for other investments or expenses. Potentially better for those with variable income or short-term financial goals. Cons. More interest paid over the life of the loan. Could result in paying significantly more for the property in the long term. Less total equity built in the property over time. Lower interest rates, higher payments, lower rates. Pros. Significant savings on the total interest paid over the mortgage period. Faster accumulation of home equity. Beneficial for long-term financial planning and wealth accumulation. Cons. Higher monthly payments can strain the current budget. Less flexibility in the monthly budget for other investments or unexpected expenses. Requires a stable and sufficient income to manage higher payments. Refinancing a mortgage. Top considerations. Assessment of current mortgage. When considering refinancing, the first step is to thoroughly evaluate your current mortgage. This assessment should focus on several key areas. 1. Interest rate. Compare your current rate to the prevailing market rates. If your rate is significantly higher, refinancing could be beneficial. 2. Mortgage terms. Review the terms of your mortgage, including the amortization period and any penalties for early payment. 3. Financial goals. Align your mortgage with your long-term financial objectives. Are you looking to reduce your monthly payments, pay off your mortgage quicker, or free up cash for other investments? 4. Equity. Determine the equity you've built up in your home. More equity can provide more refinancing options and potentially better rates. Second mortgage option. A second mortgage involves borrowing against the equity of your home while your first mortgage remains in place. This option can be considered under the following circumstances. High penalties on current mortgage. If breaking your current mortgage incurs significant penalties, a second mortgage might be more cost-effective. Specific financial needs. If you need funds for a specific purpose, like home renovations or debt consolidation, a second mortgage can be a targeted solution. Rate comparison. Sometimes the combined interest rates of the first and second mortgages might still be more favorable than refinancing the entire amount at a higher rate. Refinancing for a new mortgage. Refinancing for a new mortgage at a higher rate but better cash flow requirements can be a strategic move in certain scenarios. 1. Lower monthly payments. If your primary goal is to reduce your monthly financial burden, refinancing to extend the amortization period can lower payments, even if the interest rate is slightly higher. 2. Cash out refinance. This option allows you to tap into your home equity for large expenses, such as funding a child's education or investing in another property. 3. Debt consolidation. Refinancing can be used to consolidate high-interest debts, such as credit card balances, into a single, lower-interest mortgage payment. Case study: rental property. Investment perspective. Understanding the dynamics. When it comes to rental properties, the investment perspective shifts to balancing cash flow and interest rates to maximize return on investment, ROI. Successful rental property investments hinge on two key factors: positive cash flow and manageable interest expenses. Cash flow in rental properties. This is the net income from the property after all expenses, including mortgage payments, are paid. Positive cash flow is critical. It means the rental income exceeds the expenses, providing a regular income stream to the investor. Negative cash flow, where expenses surpass income, can strain an investor's finances, even if the property appreciates over time. Interest rates and their impact. The interest rate on your mortgage dictates a significant portion of your monthly expenses. Lower rates reduce these expenses, potentially increasing cash flow. Conversely, higher rates increase expenses, which can turn a potentially profitable investment into a financial burden. Comparative analysis. Scenarios for rental properties. Scenario 1. Positive cash flow with higher interest rate. Example: An investor secures a rental property mortgage with a higher interest rate, resulting in higher monthly payments, but manages to charge enough rent to maintain positive cash flow. Long-term profitability. Despite higher interest costs, the property generates steady income, potentially covering the extra interest expenses and yielding a profit. Risk assessment. The primary risk lies in vacancy or rent reduction, which could turn the positive cash flow negative, making the higher mortgage costs unsustainable. Scenario 2. Lower interest rate but tighter cash flow. Example: an investor refinances their rental property to a lower interest rate, reducing monthly payments but faces a competitive rental market that limits income. Long-term profitability. The lower interest rate means less money paid in interest over time, but the tight cash flow could mean minimal immediate profit. Risk assessment. The risk here is less immediate but lies in the property's long-term value and the market's rental rates. Any significant property or market downturn could affect the investment's profitability. How to choose? Here's why it's not always just about the lower interest rate. Total cost over time. A lower interest rate typically means a lower total cost over the life of the loan. However, if the loan term is significantly longer, you might end up paying more in total interest despite the lower rate. Cash flow considerations. Sometimes a slightly higher interest rate can offer better monthly cash flow management. Fees and penalties. Some loans with lower interest rates come with higher fees or penalties, such as closing costs, prepayment penalties, or annual charges. Loan flexibility. Certain loans with higher interest rates might offer more flexibility, such as the ability to make extra payments without penalty, which can be valuable for those who plan to pay off their loans early. Mortgage features. Different mortgages come with various features like fixed versus variable rates, open versus closed mortgages, and other unique attributes. Risk tolerance. Some people might prefer a slightly higher fixed rate for the certainty it provides, especially in a rising interest rate environment compared to a lower variable rate that could increase over time. Personal financial goals. Your long-term financial goals also play a significant role. Economic conditions. In fluctuating economic environments, what looks like a good deal at a lower interest rate today might not be as beneficial in the long term, depending on inflation, housing market trends, and changes in your circumstances. It's essential to consider all aspects of a loan or mortgage, including the interest rate, terms, fees, flexibility, and how it aligns with your overall financial strategy and goals. Final thoughts. The overarching theme is that there's no one-size-fits-all answer. The right strategy depends on individual circumstances, financial goals, and market conditions. Thanks for watching Forum Finanzia. Like, subscribe, and hit the bell icon for more content on mastering personal finance in Canada. See you in the next video. Thanks for watching.